Welcome, this is Rchrp 03, Accounting and Financial Management, and we'll be looking at question 2 of the paper. So I'll start with question 2A. We'll start with part A of question 2. So the application of accounting conventions has been a source of criticism on quality and relevance of the information contained in financial reports. Explain the use of each of the following conventions. Number 1, the business entity. The business entity. Business entity. So yes, this is one of the conventions of accounting. The application of accounting conventions has been a source of criticism on quality and relevance of the information contained in financial reports. Explain the use of each of the following conventions. So the question doesn't want us to explain why the conventions have been a source of criticism on quality and relevance. And instead, the question wants us to explain the use of each of the following conventions. So we'll stick to what the question is asking us. So, the first one, the business entity. The business entity is a convention. A convention is a belief that enables accounting as one of the branches of business subject. So the business entity is, yes, it is a convention, it can be a concept, depends, but the whole essence of a business entity is that a business should be treated as a totally different entity or distinct entity, or should be treated as being independent of the ownership. So it should be treated as being a totally different entity from the ownership, or being totally distinct from the ownership, or being totally independent from the ownership. What this convention means can be a convention. Sometimes it's called a principle, sometimes a concept. But the bottom line is that it is a pillar that supports the keeping of accounting records, that the business should be treated as being totally distinct from the ownership. If I'm the owner of the business, I don't have any business to do with that entity that I've started, whether it's a sole proprietorship, or it's a partnership, or it's a company. It should be a standalone, totally different from me. The point that I should not confuse my money with the business money. I should not mix my personal affairs with the business affairs. The business affairs should remain with the business. My personal affairs should remain with me. The two should not mix at any given point in time. That is what we mean by the business entity. The business should be treated as being totally independent or standalone, and we should not have any place where the business and my personal affairs mix. And this should be very strong in any setup, to the point that if I'm advancing some money to the business, I should record it as so. Instead of, some people end up treating, you assume that the business is mine and I'm the business, so we are one and the same. No, that is what this entity is all about. So it is through this, convention that we are now able to keep the books of accounts of any business. Otherwise, if you can't separate the business from the ownership, it becomes almost impossible for you to keep the books of accounts that are accurate. So this business entity convention, as used here, basically enables accurate records. Enables accurate records by a business. Enables accurate records by a business. And this is simply because we can clearly distinguish or differentiate between personal affairs, the ownership affairs, from the business affairs. And so everything that the business does remains with the business. Everything that involves the owner of the business remains with the owner of the business. But the two don't mix. The moment they mix, then we are likely to get inaccurate records. Then number two, this is, I think, number two is this one. The realization concept, and the concept and the convention. So realization concept. Now for the realization concept, this one simply states that the revenues, basically talks about the revenues. The revenues of a business should be recognized when actually realized. I don't want to repeat the word realized. When actually received. When actually received, or let's just leave it at that. The revenues of a business should be recognized when actually received. So realization simply says that we should not count something as having received when in reality we have not received it. We should be patient enough, wait until we receive it. That is the only time we can record it as having been received. You know, sometimes somebody can promise you that I'm going to pay you tomorrow. So that is not enough for you to count that as having been received. Wait until you receive before you can go ahead and record. And this one also helps a lot in ensuring accuracy of the data, which can now be relied upon by any decision maker. Otherwise, if you can record something as having been realized and you've not realized it, as in you have recorded that you have received, and in reality you have not received it, then it means that your records are going to be wrong, and so they cannot be relied upon by any person who wants to make decisions based on your records. So realization concept, we should only recognize items that have actually been received as having been received. Otherwise, don't assume or don't work on promises. Don't assume that it is so obvious I will receive, and then you go ahead and treat it as having been received. It may look so obvious, but in reality, because you've not received, there are still chances that you may not receive. So the best thing, and actually what is supposed to be done according to this convention, is that let's only recognize it in the books when we have actually received it. The actual receipt has actually been done. That's when we should record it as having been received, and it adds a lot to the accuracy and reliability of the accounting information that we are going to keep. Then we have number three. Number three is the historical cost. The historical cost concept or convention as used here. So historical cost concept, this one simply says that the records are recorded based on the actual cost received. Sorry, the actual cost paid or incurred. The records are recorded based on the actual cost paid or incurred. Historical cost. In this question, they have not added the cost, but normally we talk of the cost. Otherwise, the basic interpretation we can give to this is that all the accounting information should be recorded based on what actually transpired. Historical means something that has already been, time has already gone, it happened some time back. That is what historical stands for. So let's simply record what has actually transpired. So if we spent 10,000, then that is what we spent. We should not factor in the inflation. We should not factor in the time value of money. Let's capture the original cost that was incurred, to obtain something, or, whatever it is that happened. What is the original cost? That is what historical cost concept is all about. That's let's capture things as and how they actually happened. We should capture the costs as and how they actually happened. That is what we mean by this. Now, what's the importance of that? Again, this one helps us to make prudent or informed decisions. Informed decisions. And it also increases on the accuracy of the accounting information. And further, it acts as a reference point. We can always refer to see how much we spent on something, maybe 2 years, 3 years, 4 years ago. It's always possible if we go with this concept. Bottom line, accuracy, very important. Decision-making purposes, reliability, very important. And now we can also see reference. For reference purposes, how much did you spend? We should record based on what we actually spent, as opposed to factoring in the inflation and the, these are the time value of money things that possibly might now bring in a lot of inaccuracy in our records. Then we have number 4, materiality. Materiality is about significance. It's about the significance of the accounting information. How significant is the accounting information? And the best way to measure significance is by looking at the impact of that information, on decision making. Does it influence the decision making ability? Can it change the decision that has been made? So if the information we are talking about can change the decision at any given point in time, or can help change the decision at any given point in time, then you say that that information is material, is significant. But if it can't, then you say it is insignificant, or you say it is immaterial. So materiality concept is all about the importance attached to that information, and the importance attached to that information is basically looked at in terms of the effect of that information to the decision making ability. If it's going to change the decision making ability of the user of that account information, then we say that it is material. But if it's not going to change, it's just information that may not affect the decision making ability, then we say it is immaterial or it's insignificant. Now in accounting you say don't leave any material information unattended. Don't leave any material information unattended, because material information is significant enough to change the decision of the user. So if you leave that information out, it simply means that again the user is going to end up with wrong decisions. But for insignificant or immaterial information, you can as well, of course, not deliberately, but if left, we might not be talking of so much harm, because this is information that cannot change the decision of the day. That's why we say it's immaterial. So, in a nutshell, materiality is about the significance of the information, and if the information can change the decision-making ability of the user, then that material must be captured in the books of accounts. And what's the importance of that? Again, accuracy, reliability of the accounting information, and of course quality of the accounting information. So all of them condense to accuracy and reliability of the accounting information, which is very key. Then lastly, we have the going concern concept. Going concern, which is number 5. Going concern is more of an assumption, and it assumes that the business will be there in perpetuity. The business will be there in perpetuity. Perpetuity. This simply means that the business will be there for as long as it takes. The business will be there next week, next month, next year, the other year, 10 years from now. It's an assumption. And this assumption is very important because normally the activities of a business are not, and because we are keeping the books of a business, we assume that the business will be there to, to continue the business. It is a very key assumption because without it, perhaps we may not be able to keep the books of the books of accounts, and there will possibly be no need for us even to maintain the books. Because why maintain the books when the business will not be there tomorrow? You are buying assets. We keep that we maintain that in the balance sheet of the business, because we assume that this asset will be there tomorrow, will be there the other day, will be there the other day. It will be used. And it all comes back to this assumption here that the business will be there. We sell goods on credit, the assumption that we will be paid tomorrow. We buy inventory in numbers in the assumption that the business will be there tomorrow. So this is actually a very important assumption, and I believe at that the business will be there in perpetuity. And it is through this assumption that we can now keep the books of accounts. Otherwise, there will really be no justification for keeping the books of accounts. So this very important. It allows us to continue with everything as if assuming that normalcy, that tomorrow will be there, and so we will continue using the inventories that we have accumulated over time. The assets will continue being used. The capital will have used. The profits are going to be carried forward. It basically gives us a sense of continuity, which is very important to any business. So this, in a nutshell, we can say enables businesses to keep records, and it basically justifies record keeping. Justifies record keeping. It justifies record keeping, and of course, in the most accurate manner. So those are the 5 conventions that we have here, and I think we've discussed all of them. The business entity, that the business should be treated totally different from the owners. Materiality, any information that is significant to influence the decision of the user should be considered as being material and must be captured or included when we are talking about accounting records. Realization, we should only recognize sales or receipts when we have actually received them and not just hoping. The going concern, the business will be there in perpetuity, in continuity over the years that are coming. Then historical costs, we should capture all the records as per what actually happened. So those are the 5 conventions. Let's look at part B of the question. The following information was extracted from the books of Sunrise Limited for the ended 30th September 2022. Income statement, we have that. Sales, cost of sales, opening profit, interest expense. Then balance sheet, we have that. Debtors, cash at bank, current liability, long-term loan, and shareholders. So we are supposed to compute. This is a question from this topic called ratio analysis. To compute the following ratio: acid test ratio. Now, acid test ratio. This is a liquidity ratio, and it's one of the liquidity ratio, and it shows how fast the business can easily meet its maturing obligations. Fast maturing obligation, not just maturing obligation. So acid test ratio, the formula is, formula for calculating this is current assets minus inventory and minus also treasury bills if we have. In this question I've already seen you don't have treasury bills, over current liabilities. When we talk about liquidity ratios, what comes out as outstanding are the current assets and the current liabilities. And in fact, we have a ratio that simply talks about current assets and current liabilities called there's a name for it. Okay, so for now we have this acid test ratio, and the acid test ratio is current assets minus inventory minus treasury bills over current liabilities. We are deducting this inventory and treasury bill because our interest is on how fast we can meet the immediate maturing bills. How fast. And so that's why even from the name you can see acid test. Remember how acid is very reactive. So you just want to know if a certain mature obligation arises, how fast. And when we talk about how fast, inventory might not really help us. The inventory is part of current assets. Treasury bills are part of current assets, but these ones might not be of so much help at that situation, because it's like an emergency. So probably cash will do, debtors will do, and such like stuff. So that's why we are deducting this inventory and treasury bills, so that we get only money that can be of help to us as at that particular time of need. So what are the current assets here? Simply come back to the question, current assets. These are current assets. Debtors is a current asset. Cash at bank is a current asset. Inventory is also a current asset, but now inventory is part of what now we are not so. It may not really help us at this particular time, because of we are looking at the acid test ratio. So inventory might not really be of so much help at this particular time. So let's just pick what is important to us. And we have now the debtors plus the cash at bank, because we've not been given the current assets in total. So we'll just take what is important to us. Debtors plus cash at bank over current liabilities. So what are the current liabilities? Remember, I've said all these are current assets, but we'll still have taken the total of current assets minus inventory. So there's no need of taking current assets minus inventory, which is this. It's as good as saying, let's just take the remaining current assets, which are now the debtors plus the cash at bank. That gives us 86,000. And then for the current liabilities, we've been given the total, which is 98,000. So this will be 86,000 over 98,000. And it's normally a ratio, so we don't have to multiply by 100. The 86,000 is debtors 46,000, cash at bank 40,000, make it 86,000. So let's just divide that figure, and we'll get the answer. It's normally a ratio, so this will give you the calculator. So 86,000 divided by 98,000, you get 0.88. So we say the ratio is 1 to 0.88. That is the answer to that question. So you can say 0.88 or 1 to 0.88. So this is the answer, 0.88. When you divide this 86,000 divided by 98, 0.88. So we compare it to 1. And of course, from this you can see what this means is that the company may not be doing so much well in terms of its ability to meet the fast maturing debts. And that one is evident because you can see what they have at their disposal is 86,000, and the current liabilities are 98,000. So liabilities are in excess of the cash that they can raise within a short period of time. Okay, so let's go to number 2, inventory turnover. Inventory turnover, how fast the inventories are converted into sales. How fast the inventories are converted into sales. How fast the inventories are converted into sales. So you can talk of inventory turnover as being, the formula is cost of goods sold. Cost of goods sold over, this is inventory, so over inventory. Normally talk of the average inventory. The average inventory is opening inventory plus closing inventory. So opening stock plus closing stock. And this is cost of goods sold. Now cost of goods sold, how do we get cost of goods sold? Cost of goods sold is sales minus cost of sales. Sorry, this is not this will give you gross profit. Cost of goods sold is the opening stock plus purchases minus, and it's good in this question we've just been given the cost of sales here. So cost of sales has been given as 258,000. So we've already been given cost of sales or cost of goods sold as 258,000. So we'll simply come here and say, this one is not, because it's direct, just come here and say 258,000 divided by average inventory. So for average inventory, we have opening inventory and closing inventory. So whatever it is that is here is closing inventory, which is now 100,000. And opening inventory, we've not been given the opening inventory. So if we've not been given the opening inventory, we can as well just assume, and because we have only one inventory, so we'll just work with the one inventory. Otherwise, we'll have been given here opening inventory plus opening inventory plus purchases. Then of course, if we less the closing stock, that's when we get the cost of sales. But we've not gone that direction. We don't have the purchases. They have also not given us the opening stock. They have just given us the cost of sales. So let's ignore that. Let's just assume we have the inventory, one closing inventory. And so we'll just work with that. So this will be 258,000 divided by 100,000. And for inventory, for any time we talk about turnover simply means how fast the inventory can be turned into sales. So we might want to, in fact, most of the turnover, those are activity ratios, will go with the number of days. So you can talk of times 365, so that when you divide here, you get 2.58 times. Let me just check inventory turnover. In fact, we don't have to add the 365, so we'll just talk of 2.58 times. 2.58 times. That is the activity rate. We'll talk of 2.58 times, and that is the cost of goods sold, 258,000, divided by the average inventory opening plus closing inventory, which in our case we don't have the opening, so we'll just assume 100,000 because that's the only inventory that we have. So cost of goods sold over average inventory, we have 2.58. Then we'll have it as times the number of times, that is the turnover. We can either express it in days or the activity, the number of times. And so in this case, we'll go with 2.58 times. Remember, the units are very important. For the first one, these are liquidity ratio. And liquidity ratio, we express the answer in terms of ratios. And then this is a inventory turnover is an activity ratio. So we expect it in number of times or the days. So let's go to the third item. The third item is average collection period. And average collection period, the formula is average receivables. The question here we're asking is how long will it take for us to collect money? And we collect money, of course, from the debtors. We collect money from the debtors, and we can only collect money from what we've sold. So the two main variables are sales and debtors. And so when you talk about the formula, we'll have it as average receivables. This is average debtors, of course, over the net credit sales. Net credit sales. So sales that have been sold on credit. Those are the only sales that will help us, will lead to debtors. Otherwise, if they are sold, if goods are sold on cash, then we will not have the debtors. We can only have the debtors if the goods are sold on credit. That explains why the formula takes this shape. So average collection period, how long does it take for us to collect money, of course, for the goods sold from the debtors? So you have average receivables over the net credit sales. Average receivables, let's just go to the debtors. In complex questions, of course, you will have the closing balance for debtors for the previous year, and then the closing balance for debtors for the current year. So you add the two. But this one is not a complex question. This is a very simple question. We only have one debtors figure, which is 46,000. So it makes it even easier. But if we'll be having 2 years, for example, we'll have the closing balance of the previous year and the closing balance of the current year. Those are the two debtors balances that we'll add, then divide by 2 to get the average. But in this case, we've only been given one data figure. So we'll take it as it is. That this will give us 46,000 over net credit sales. The net credit sales, again, here the question has not told us the credit sales. It's not very clear on whether the sales are on credit or in cash. So for the sake of it, we will assume that all the sales are on credit. Otherwise, the question should have been clear to tell us credit sales, cash sales. Because the question has not told us anything, we will not assume that these were cash sales. If they were cash sales, then we will not be having any debtors. Debtors only arise when we have credit sales. So we will safely assume that these are credit sales. So 497,000. So 46,000 divided by 497,000. And then because we are talking about collection period here, we'll multiply this by 365 days in a year. 365 days in a year to get the number of days it will take, or months or weeks it will take for us to collect this money from the debtors. So simply go back to your calculator and we'll have 46,000 divided by 497,000 times 365. This gives us 33.78. So 33.78 days. You can simply call it 34 days. That it takes 34 days to collect money from the debtors. That is the answer to that question. Go to Roman 4. Return on capital employed. Now, return on capital employed. The formula for this is EBIT. EBIT is earnings before interest and tax. Earnings before interest and tax divided by capital employed. Capital employed. And capital employed is equals to total assets minus current liabilities. So, earnings before interest and tax. In our question here, I think we've been given that it's quite straightforward. Opening profit. $197 minus 258. I think this was not supposed to be opening profit. It should be operating profit. It was not supposed to be opening profit. Instead, it should not be opening profit. Instead, it should be operating profit. Because if we less cost of sales from the sales, we get to 39,000. This is supposed to be our gross profit. Gross profit. So possibly when we less the expenses, that's when we get now 138,000 as our operating profit. So we'll assume this is our operating profit. That will be the profit. So, and of course they have not deducted the interest expense, so we'll retain it at that. So 138,000 EBIT, earnings before interest and tax, 138,000. It's not opening profit, it should be operating profit. It should be operating profit, and that is now the profit that should now be subjected to interest and tax. But the formula doesn't want us to subject it to interest. So we'll pick it as it is, 138,000 divided by capital employed is total assets. So you simply come back here, get the total assets, and our total assets is 100 plus 46 plus 40. This is 186,000. Then that is the total assets. We don't have any other non-current asset. Yeah, that is the current assets, total assets actually, minus 98. So 186,000 minus 98, which is our current liability. We don't have to go to this other direction of long-term and shareholders loan. Let's just stick to this. So we'll say 138,000 over the total assets is 188,000 minus current liability is this one 98,000. 186,000 minus 98,000. So 186,000 minus 98,000. So this gives us 138,000 over 88,000. that will give us 1.57. 1.57. Now it's very important my screen has lost. Okay, so that one gives us 1.57. So let's go to the last one. Debt equity ratio. Debt equity ratio. And as the question goes, you can clearly tell that this is a ratio. So for ratios, what do? We simply divide. And the formula for debt equity ratio is equals to total debts over total debts over total, or rather the shareholders' equity over the shareholders' equity. So total debts just get both the long-term and short-term, long-term and current debts. And in this case, we'll have 98,000 plus 33,000 over shareholders' equity, which is 197,000. So add this plus this to get the total debt, and then divided by the equity, which is 197,000. So that one is straightforward. We'll have 98,000 plus 33,000 over 197,000. This gives us 131,000 over 197,000. And because it's a ratio, we'll just have it. Whatever we get after this division will be our answer. So this will be 131,000 divided by 197,000. That gives us 0.66. 0.66. So that becomes our answer. It's a ratio. So you can just say 1 to 0.66. All this means is that we are not doing so well. We are not doing so well. The debts are actually lower than the equity, and we are supposed to maximize that. Debts are a potential to the business. It's an opportunity that we can exploit. So the ratio is 1 to 0.66. That is the answer to this question. So that's how we are supposed to go through all this. This is a question on ratios. Those are the answers. And then the first part was a question on theory. That is the answer. Thank you. Let's meet in the next question.